In today's video, let's talk about private equity's 4 trillion backlog and what it means for markets, for LPs, and for the industry's future. Let's start with the numbers behind the backlog. Private equity firms are sitting on record mountain of unsold assets, and according to Bain & Company's latest annual report, the total value of the companies inside the buyout funds climbed to 3.8 trillion in 2025, a 3% increase year on year, even as the industry managed to execute over 700 billion in exits during the same period. The exit figure, that is 717 billion, was actually the second highest on record, trailing only the pandemic-fueled deal-making frenzy of 2021. But it wasn't nearly enough to offset the sheer volume of aging portfolio companies. The backlog kept growing. What makes this particularly important is that the accumulation is happening despite an uptick in activity. The industry isn't frozen, it's just not moving fast enough to clear the overhang. So next, let's try and understand as to why the logjam persists. The root cause traces back to 2022 when the central banks aggressively raised interest rates to combat inflation. The higher financing costs made leveraged buyouts more expensive, compressed deal multiples, and created a valuation gap between the buyers and the sellers. That gap has narrowed, but it has not closed. Hugh McArthur, who chairs Bain's global private equity practice, offers a sobering assessment out here. He shares that there is little prospect of the rates declining sharply in the near term, which means that the firms cannot count on multiple expansion, the valuation tailwind that powered returns for much of the previous decade, to bail them out. The holding periods have stretched accordingly. The average time to exit has risen approximately 7 years, up from 5 to 6 years norm during the 2010 to 2021 era. Bain's research further shows that the longer a portfolio company sits inside a fund, the lower its incremental value creation tends to be, particularly once it passes the 8-year mark. And this brings us to the rise of the zombie funds. Perhaps the most striking symptom of the backlog is the surge of the so-called zombie funds. Zombie funds are the vehicles that continue to hold on aging investments, but they can no longer deploy fresh capital. The data from Preqin reveals that the unrealized value of private equity vehicles more than a decade old has risen sixfold over the past 10 years, surpassing 1 trillion as of mid-2025. During the same period, the industry's total assets only tripled. Zombie funds represent a structural challenge out here. They tie up limited partner capital in illiquid aging positions, reducing the pool of money available for reallocation. For general partners managing these vehicles, the incentive to create value diminish over time as management fees wind down and carry becomes increasingly unlikely. Next, let's talk about the tale of two industries out here. So what we are seeing is that beneath the aggregate figures, a divergence is emerging. The largest buyout firms are pulling away from the smaller competitors. 7 large exits accounted for roughly 1/5 of the total exit value in 2025, and 13 mega deals drove most of the increase in acquisition volumes, which rose nearly 50% to $904 billion. Meanwhile, the number of individual deals actually declined by 2%. This means that the headline improvement was driven by a handful of outsized transactions rather than a broad recovery in deal-making activity. The fundraising landscape also tells a similar story. Total fund closing fell by 23% last year as limited partners, starved of distributions from existing investments, grew more selective about where to commit new capital. Larger brand name managers with strong track records are attracting a disproportionate amount of commitments, while the mid-market and emerging managers face a tougher environment.